Welcome to the fourth video series from VAST. My name is Jay Hillier. The first video was Bonding 101. The second video was surety programs and their requirements. And the third was establishing a line of authority. And the final fourth video is tax strategies versus investment bonding. This will increase your bonding capacity for your company. For this video, tax strategy and investment bonding, as a business owner who seeks to obtain bonding for projects, you must have a conversation with your CPA as they focus 100% in reducing your tax liability at the end of every taxable year. This is completely in contrast to a young company that wants to build up their shareholder equity and their working capital, which is required to increase your bonding capacity to look for larger projects, more projects in a given year, and of course, better bonding rates. Your tax accountant would suggest on a profitable year to buy a new truck, to buy more equipment, when a surety representative would suggest you finance the truck, you finance the equipment, and keep the cash in the business to build up your working capital. So you can see the catch-22 is that you would have to pay more taxes as you build up your working capital and your stockholders' equity, which is necessary to give the underwriter in surety the ability to support you in more projects in a given year, in larger projects, which seem to me more often with the cost of materials and labor these days. So what is stockholder equity? This refers to the hard assets remaining in the business once all of the liabilities have been settled on those assets. Now let's look at working capital. You have heard the term cash is king. Current assets minus current liabilities, which current assets are short-term in nature and can be converted quickly into cash, primarily accounts receivable, inventory, which gives a contractor the ability to support startup costs on projects, to support them during slow pay, delays, without going into their bank line of credit, which can be another tool to increase your working capital, all of which causes a company to pay more taxes and the need for them to communicate with their accountant their strategy to build equity and working capital for bonding. To summarize tax strategy versus investment bonding, you can see that investing while paying taxes in your company will increase your bonding capacity and achieve better rate over time. And this can be done quickly in a good year, but you must have a 5-year goal to really achieve the working capital and stockholder equity to bid on projects on a regular basis from a surety standpoint. So please communicate your plan with your CPA or tax accountant to really develop a good program. Thank you.